because no power in our university due to that internet connection was not connected, and now mobile hotspot and mobile hotspot. Okay, today I'm going to discuss about that is analysis and interpretation of financial statement, analysis and interpretation of financial statement. Here, analysis and interpretation of financial statement. These are techniques. These are techniques. Most important techniques for accounting. In accounting, we have seen that is basis of accounting. Basis of accounting. That is accounting gap, generally accepted accounting principles, and accounting concepts are most important. Then accounting conventions. After that, we discuss about that bookkeeping, accounting, and other aspects of accounting. Because analysis and interpretation of financial statement is one of the most important techniques of different techniques of that is accounting. What are all the analysis and interpretation of financial statements techniques? Then meaning of financial statement. The financial statement means analysis and interpretation of financial statement refers to the process of determining financial strength and weakness of a firm. It is a process. Analysis and interpretation of financial statement is a process of determining to determine the what we are going to determine the financial strength and weakness of a firm. Financial strength in the sense if the company make a profit, or weakness if the company incur a loss. Not only for this, that also financial strength in the sense because assets liabilities are more, that is financial strength, and weakness, that is liabilities are more. Profit as well as that is assets and losses as well as liability, that tells about that. In trading account, gross profit or gross lot, it mentioned that. Then in case of profit and loss account, gross profit and loss account, net profit or net loss, it tells about that. Then in case of balance sheet, what is the asset liability, what is the liability of the organizations, what are all the assets of the organization, this financial statement tells about that. Therefore, this financial statement tells about it is a process. It is a process of, because preparation process is nothing but it is a preparation of different techniques of, that is books of accounting. In basically we prepare trading account, profit and loss account, appropriation account, and balance sheet. And the other technique is also there. We will discuss later. Then it tells about it tells about the financial strength and weakness of a firm by establishing strategic relationship between the strategic relationship each and every, because here trading account, we prepare trading account related to profit and loss account. Therefore, balance brought down, carried down in the gross profit. For example, gross profit that is carried down, then that is brought forward to profit and loss account. In the P&L account, we net gross profit brought down. That is a strategic relationship. Each and every activity, business activity, having its own relationship. You take an example. In an organization, we have seen n number of departments. It may be 10 departments, 15 departments. What is the existence? What is the necessity of that is establishing those departments? Each and every activities are most important. In that connection, the organization, you take an example, purchase department. Why we need purchase department? To purchase raw material and other that is related, business related goods and services and assets and assets, that is we need purchase department. Because why we need purchase department? They are the specialized persons. Where to purchase, when to purchase, how to purchase. That is most important. Each and every paisa, each and every rupee is most important in business. How to purchase, where to purchase, when to purchase, whom to purchase. These are all most important for that. Therefore, it tells about the strategic relationship, each and every activity. Purchase department related to marketing department, marketing related department to accounts department, accounts department related to finance department, finance department related to HR department, department related to R&D, research and development department, then etc. etc. It depending upon the significance of the organization, the different departments divided. Existence of the different department, it depending upon the significance of the organization. Therefore, here it tells about it is a process of determining financial analysis and interpretation of financial statement is a process of determining financial strength and weakness of a business organization by establishing strategic relationship between the balance sheet and profit and loss account and appropriation account and trading account and other operative data. What are all the books of accounts in books of organization? We are not going to prepare only trading account or profit and loss account or balance sheet or appropriation account. Other techniques are there. I will explain in detail. What are all the techniques that is most essential for the business organization? Because each techniques tells about the significance of the organization, financial strength of the organization, financial weakness of the organization. It exhibits the relationship between the different departments, different activities. Therefore, these financial statements are most important. This is a techniques, or these financial statement techniques are most important for these business organizations. Analysis and interpretation. What do you mean by that? Analysis and interpretation. Analysis, here we have seen two words. One is analysis, another one is interpretation. Analyzing the information, business related information, analyzing the business related information, analyzing, interpreting the results. What is happening in that? I will tell you that. I will explain that. What is the meaning of analysis and what is the meaning of that is interpretations. Here in this analysis and interpretation, there are four important in general analysis. General analysis. One is vertical analysis. Another one is horizontal analysis. The third one is internal analysis. The fourth one is external analysis. These are all the four important, that is analysis and interpretation of financial statements. Yes. What do you mean by that? Vertical analysis. The word itself says that. Vertical. In accounting that is system, vertical analysis means it is analyzed only 1 year financial statement. Vertical analysis in accounting system, the vertical analysis means it is analyzed only 1 year financial statement. That is vertical analysis. Only 1 year. For example, you take an example in profit and loss account, trading account, profit and loss account, analysis of financial statement in 1 year. Because for example, trading account, profit and loss account and balance sheet. Here vertical analysis, what happened? What the accountant or what we are doing, what we need to do that. Here it is analyzed only 1 year financial statement. Sales is the basis for, because the basis for that is comparing other components. Analyze only 1 year financial statement. If we take the only 1 year financial statement and compare with other expenses, other incomes, then we will come to know that is what is the exact ratios of that particular activity. In case of income statement, sales is the base. Income in case of balance sheet, balance statement, that is total is the base. You divide that total and liability, sundry debtors and liability, total of that balance sheet, total like that. That is, it is vertical analysis means it is analyzed only 1 year financial statement. That is the meaning of that. I hope you understand that. Horizontal analysis. What do you mean by that? In Accounting horizontal analysis means it is analyzed several years or more than 1 year financial statement. This is a one word answer, simple answer. Horizontal means more than 1 year. For example, 2018 financial statement book, that is trading account, profit and loss account and balance sheet, compare with 2021 trading account, profit and loss account and balance sheet. Only 1 year, not only several years. In case of vertical analysis, only 1 year financial statement that is analyzed. In case of horizontal analysis, that is several years or more than 1 year. For example, 5 years. 5 years analysis or 118 information to compare with 19 information, 18 to 19 or more than 1 year. 5 years information analyzing that. Why these analyses are most important? To take appropriate decisions. Planning, that is most important. Planning is most important for every activity in business organization. Planning are most important. On the basis of the horizontal analysis or vertical analysis, we go for prepare a plan. How to purchase, how much we need to purchase for next year, what is the next year budget. You take an example in every organization, in a government is also, because in government is concerned central government, state government and local government. Each and every government, central government having its own budget. What do you mean by budget? Why we prepare budget? Budget is a plan of action for future period, tomorrow, next day, tomorrow or next year. Therefore, why we need this analysis and interpretation, that is vertical analysis and horizontal analysis, to plan properly for the future period. Therefore, we need it. I hope you understand that. What is the meaning of vertical analysis and what is the meaning of horizontal analysis. Next one, internal analysis. The word itself says that internal analysis. What do you mean by that internal analysis? Internal analysis means assess the books of accounts in internal stakeholders. Assess the books of accounts. Books of business organization, books of accounts. Books of accounts in the sense, assess all the aspects of the books of accounts. That's the aspects in the sense, whatever the transaction that took place in the organization, whatever the activity that is took place in the organization, particular year, 2020, whatever the activity that is incurred or took place in the 2020, that is assess the books of accounts in internal stakeholders. Our accounting departments, internal stakeholders are accounting department and the internal audit also, internal auditors. Internal auditor, word itself, internal analysis. Accountant, the duty of the accounting department is to prepare the books of accounts as per the regulations, as per the rules of accounting system. IFRS, GAAP, according to GAAP, generally accepted accounting principles. We need to prepare that. Then IFRS, International Financial Reporting Standards. IFRS, according as per the regulations of the IFRS, or IAS, Indian Accounting Standards. That is internal people. Accounting department has to prepare the books of accounts as per the accounting system. That is, we call it as an, and then internal auditors. Internal auditor is also, we call it as an, that is internal analysis. That is also most important, because if you could submit outside, we need to prepare books of accounts as per the accounting system. Then external analysis. External analysis means except management, all other external stakeholders. Except management. Here, external analysis means except management. Management is also because board of directors, CEO, board of directors, and all other external stakeholders, government or auditors, that is compulsory. Books of accounts, certification of books of accounts of auditors, external auditors, government auditors are compulsory. That is external. Then stakeholders, that is investor, is also an external party. They want to know the They are investing money on that. They also want to know the financial position of the organization. Why they are investing? To make a profit in the form of dividend, in the form of equity shares, in the form of preference shares. Why they invested? They invested money on to make dividend, to earn profit. Yes, this is, I hope you understand that vertical analysis, only 1 year, or horizontal analysis, several years, or 2 years, or more than 2 years, then internal analysis, that is, assess the books of accounts in internal stakeholders, then external analysis means except management, all other stakeholders, outsiders, public, government, then investors, then other parties, customers. Customers are also outside parties. Why the customers want to know the financial position of the organization? Because you want to buy the product. Yes, that is also, this is the simple in general, the analysis and interpretation of financial statements. Next, techniques. What are all the techniques we are using? General analysis and interpretation of financial statement. These what are all the techniques of financial statement analysis, financial analysis of financial statement, techniques of analysis of financial statements. The first one is trend analysis or percentage analysis. Trend is also nothing but percentage analysis. Common size income statement, comparative statement, ratio analysis, fund flow analysis, cash flow analysis, and marginal costing, and other techniques. These are all the techniques of analysis of financial statements. Then what is the meaning of trend analysis? Trend percentages, common size income statement, comparative statement, ratio analysis, fund flow statement, cash flow statement, and marginal costing, and other techniques. Here, the first one, trend analysis. What do you mean by the trend analysis? Trend analysis means it is a technique used to measure the actual performance and predict the future prospects of the business. Two important aspects we have seen in this trend analysis. One is actual performance. What is the actual performance of the organization? Actual performance. Then predict the future prospects of the business. Predict. Therefore, trend analysis. Trend. What is the trend of the profit? Gross profit, sales trend of the 4 years or 5 years. What is the sales trend? That is most important. With the help of that trend, we need to purchase, we need to plan properly for the next year. This is most important. Trend analysis, actual performance of the organization, and we compare with predict the futures. We need to predict the future. Next year, what will be the that is sales. That is most one, then purchase of raw material, then human resources, then capital formation. Each and every activities that predict the future in an organization. Organization has to predict the future and actual with future. That is, we call it as an, if we compare that, that is, we call it as an trend analysis or percentage analysis or trend analysis. This is also most important. For each and every activity, actual performance, compare with, predict the future, plan that future. That is the meaning of trend analysis. Then common size statement. A common size financial statement display all items as percentage of common base figure, common size, rather than absolute numerical figures. Here, display all items as percentage of common base figure. For example, I explained that in case of income statement, sales is the base. Sales is the base divided. For example, wages, sales divided by wages divided by sales into 100 is equal to what is the percentage of wages in that organization. We can easily find out that is common size statement, common size income statement, and common size position statement. Position means balance sheet. Balance sheet tells about the position of the organization. Income statement is nothing but trading and profit and loss account. Appropriation account tells about the profit of the organization. What is the profit or what is the loss of the organization? Position statement tells about the what is the liability position of the organization and what is the asset position of the organization. Here, percentage. I explained that. In case of common size income statement, sales is the base. If you go for analyzing the all the aspects in the income statement, that is profit and loss account and profit and trading and profit and loss account, sales is the base. Then in case of position statement, total is the base. That is the meaning of common size statement. Because due to time constraint, I am not going to solve the problems because these problems that is available in our study material. You go through that because accounting is very difficult. Because with all that, I try to my that is level best to solve the problem in slides also in the online class also. I try to that because I need it is our because theory subject is concerned, that is not a problem. And but in problem related subject is concerned, it is very difficult to because explain and solve the problems in the classes. Yes, with all that, I do my level best. Okay. Then third one, comparative statement. It is a statement exhibit the financial position of different period of time. Year 18. What is the compare with 1 year? 18 to 19, 19 to 20, 20 to 5 years comparison. What is the percentage of comparative statement? If we compare that, then only we can find that where we can lack of that is knowledge or where we fail to that is accomplish the work effectively and efficiently. This also comparative statement means different periods. It was to exhibit the financial position of the, for example, 2018, what is the financial position or at a liability position or sales position, and everything tells about the everything. 1 minute. Hello. Hello.
Hello.
Yeah, tell me.
Sir, this is Vivi Amina speaking.
Tell me. I am in class.
Oh, okay, sir. I'll call you when you
Okay. Yeah. Comparative statement means it is a statement exhibit the financial position of different periods. 1 year to another year or 5 years. If we compare that, why this comparison is percentage? Comparative statement is most important because comparison is most important. For 18, what is the position of the 18? Wages position, salary position, rent position, each and every rupee, each and every paisa influences on the profit of the organization, loss of the organization. Therefore, this analysis, comparative statement with different periods is also most important. Each and every aspects, goodwill, liability, creditors, debtors, purchases, closing stock, opening stock, wages, fuel, each and every aspects. If you compare that of the 5 years, then you will come to know that where you are lacking, where you are failed, where the organization has failed. Yes, these that is analysis and interpretation techniques are most important. Trend analysis, common size income statement or position statement, and comparative statement. These are all most important for every business organization. Every activity is unique in that organization. Every activity is unique. It tells about the significance of the activity. Yes, the next one, ratio analysis. The meaning of what do you mean by ratio analysis? These most important techniques of analysis and interpretation of financial statement. These are most important techniques of any organization for that matter. Ratio analysis is most important. This is one of the most important techniques. What do you mean by ratio? Ratio analysis. Ratio analysis, it tells about it expresses the mathematical relationship between one number and another number. It tells about it exists the relationship between the one number to another number. one concept to another concept. You take an example. What is the ratio? Gross profit ratio. Gross profit divided by sales. It tells about the relationship between the gross profit and sales. What is the current ratio? Current ratio divided by current ratio is equal to current assets divided by current liabilities. It tells about the two aspects, two components. Current assets, what is the total of the current assets, what is the total of the current liability, it tells about that. That is ratio. Then capital employed. Capital employed is equal to debt plus equity. What do you mean by debt? Are you find the difference between debt and equity? What do you mean by debt? Debt is a loan or borrowed from the institution or an individual or a bank or whatever it may be. Then equity means shareholders. They are the real owners of the company. Equity shareholders. We call it as an real owners of the company. Why the shareholders? We call it as an real owners of the company. Because here capital is also equity capital or preference capital. In capital formation, there are two types of capital owners. One is equity shareholders, another one is preference shareholders. The word itself says that equity. Because investment, I don't know how many of you have this knowledge of equity. Investment on equity shares, equity, that is, they are the real owners. Yes, there are different concepts. If I explain that, I will take almost half an hour to explain this concept, the difference between equity, then preference and debt and everything. Because here in simple word, I've explained that equity, shareholders, for example, if the organization earn a profit of rupees 10,000, how we this profit that is divided into different investors, because we need to divide that profit into equity shareholders in the form of dividend, then preference shareholders in the form of preference dividend, then that is in case of loans and advances in the interest, in the form of interest. You find the difference between, in case of shareholders, that is dividend, we call it as a dividend. But in case of investment or loans is concerned, interest. Why that interest? Interest is why this difference between, because that is also one of the investment, this is also one of the investment. The difference is here, if the company make a profit or not, interest payment is must. If the company incur losses, the business organization or the company need to pay the interest. Therefore, debt. Investment on debt. If the company make a profit or not, company has to pay the debt loan. That is loan, interest on loan. They have to pay that. But in case of equity is concerned, if the company make a profit, then only they go for declaring dividend. Then in that equity and the preference shareholders, the word itself says that preference shareholders, while declaring dividend, preference given to preference shareholders. That's all. After that, they go for equity shareholders. This is the ratio analysis. Most important techniques here. It exists the relationship between the two components or two aspects or two numbers. Then the next one is fund flow statement. This also, it refers to changes in working capital. Why you prepare fund flow statement? Changes in working capital between two periods. Therefore, we go for prepare fund flow statement. Here, I will explain that in detail. What is that ratio? Then problem is also, I will solve the problem on ratio analysis. This is most important from the point of view of examination. Then fund flow. This also I will explain in detail. Pro forma and all. I will this in fund flow. Pro forma is most important. That is in case of cash flow is also, it is one of the most important techniques in the present scenario. Ratio and cash flow statement is most important in the present scenario. It is a statement of changes in cash position of the organization between the two periods, because that is here in case of cash flow statement, that is opening balance, cash balances begins with opening balance and ends with, that is cash position. opening with cash at bank, and bank opens with opening balance and ends with that is closing balance for the two periods. This is the simple and direct that is the meaning of that is different techniques of that is six techniques almost. Marginal costing is also I will explain in that in future slides. I will future classes I will explain that. Here the most important one, that is trend analysis, one of the important techniques. Then common size income, common size statement is also this income statement, and position statement is also one of the important techniques. Then comparative statement, 2 years compare that, that is also most important. Then ratio analysis, one of the important techniques. Fund flow, to know the financial the working capital changes in working capital, we go for that is prepare a fund flow statement. Then cash flow statement, that is cash position of the organization. Between the changes, what is the changes in the cash position of the organization, begins with opening balance, ends with closing balance. This is the simple meaning of that is different techniques of financial statement, analysis of financial statement. Then ratio analysis problem. This is I will give you one simple problem on this. This is the way they will provide in the examination. This type or another type is also there. Give percentage. We need to convert it. The modern that is traditionally we are using this method, that is a problem on ratio analysis, that is problem ABC Limited provide this is a problem on ratio analysis. ABC Limited provides you the following financial statement for the year ended 31st 12 2018. This is income statement. Then what is that information transaction on this ABC Limited in financial statement analysis? To opening stock 99,500, purchases 5,45,250. That is two incidental expenses 14,250. That is gross profit. Then before that, come to the credit side, that is sales 8,50,000. The closing balance is 1,49,000. The difference is here is credit side is more, debit side is very less. Therefore, here 8 lakh plus 1,49,000, that is 9,99,000. That is the total. Then the 9,99,000 minus 5,45,000, 14,000. The difference we call it as a gross profit, that is 3,40,000. That is gross profit. Then if you go for profit and loss account, by gross profit brought down from that trading account 3,40,000. Then debit side, that is selling and distribution, indirect expenses. Direct expenses, that is in the trading account, and indirect expenses, that is in the profit and loss account. Selling and distribution expenses 30,000, administration expenses 1,50,000, interest 15,000, then non-operating incomes that is 4,000. This is the debit balances of the profit and loss account. Then here in this ABC Limited, they provide that non-operating income is also they provided 9,000. Then here is also the credit side is more, that is 3,40,000, but 9,000, 3,49,000. Then the difference of 3,49,000 minus 30,000, 1,50,000, 15,000, 4,000. Then difference is 1,50,000. This is about the income statement information. This type of information, the trial balance they will not provide. If they provide trial balance, we need to prepare the trading account, profit and loss account, and balance sheet. In this, usually in the ratio analysis, they provide the trading account and profit and loss account usually, and the position statement, income statement and position statement they provided. These are income statement. Then these and position statement are on balance sheet. Liability amount, assets amount, 2,000 equity shares of rupees 100 each, 2 lakhs. Debenture 70,000, reserves 20,000, creditors 40,000, bills payable 60,000, order of 30,000, P&L account 60,000. Then total is 4,80,000. This and position statement. It tells about the position. This should be tally. In case of trading account, difference. Either it may be gross loss or gross profit. Then in case of profit and loss account, either it may be gross profit or net profit or net loss. But in case of balance sheet is concerned, this is a statement. This is not an account. Account, we can find the difference. Left hand side or right hand side, a debit side or credit side. But in case of balance sheet, no such. This is a statement total 4,80,000. And come to the asset side, land and building 1,50,000, plant and machinery 80,000. Then stock in trade 1,49,000, sundry data 71,000, cash and bank balance 30,000. Total is 4,80,000. This is the income statement. Usually in ratio analysis, the income statement and position statement they will provide it. Otherwise, in the form of percentage is also, you go through that our study material, then you will come to know that. Yes, position say income statement information and position statement information. With the help of this, we need to prepare some a solution to this. Yes, here we need to calculate that. What are all the ratios? Here 15 ratios. We need to calculate the 15 ratios. Calculate the following ratios for the purpose of analyzing the financial position of the ABC Limited. Yes, that is current ratio. We need to calculate the quick ratio, debt equity ratio, fixed ratio, fixed asset ratio, fixed asset to net worth ratio, proprietary ratio, stock turnover ratio, fixed asset turnover ratio, total assets turnover ratio, owned capital turnover ratio, interest coverage ratio, operating profit ratio, net profit ratio, gross profit ratio, net profit to net worth ratio. Here, with the help of this income statement and position statement, we need to prepare 15 ratios. We need to calculate the 15 ratios. Yes, before that, we need to calculate some analysis, income statement, and we need some information. Otherwise, it is very difficult to solve the ratios. Yes, here analysis of income statement. Yes, this is in vertical form or horizontal form. This is in vertical horizontal. I will show you that. Vertical analysis and horizontal analysis. P&L account is always, we call it as an horizontal. This is vertical analysis. Analysis means vertical analysis. Okay, here sales income statement, we need to prepare income statement. This is most important for that is to calculate the some information we needed. Yes, therefore sales outer column here particular, then inner column and outer column, that is income statement, that is in vertical analysis. Here sales that is 8,50,000 less cost of goods sold. Cost of goods sold means that is this is the most important concept. You need to understand that cost of goods sold is equal to opening stock plus purchases plus direct expenses minus closing stock is equal to that is cost of goods sold. Here is also incidental expenses is also direct expenses. That is the meaning of that. Oh, cost of goods sold is equal to, you write down that. You write down cost of goods sold. This is most important. While preparing ratio analysis, cost of goods sold, stock turnover ratio, we need to find out the cost of goods sold. How to find out the cost of goods sold? Cost of goods sold is equal to opening stock plus purchases plus incidental or direct expenses of the trading account and minus closing stock is equal to cost of goods sold. This is most important, cost of goods sold. Okay, here opening stock that is 99,500, purchases 5,45,250, then incidental expenses that is direct expenses 14,500, that is also available on the problem. Then total no other expenses or items we left in this opening stock plus purchases plus direct expenses minus closing stock. That is closing stock is also that is provided in that 1,49,000. Then cost of goods sold is equal to 5,40,000. Opening stock add purchases add incidental or direct expenses minus total that, then minus closing stock is equal to cost of goods sold. Cost of goods sold is equal to 5,10,000 a year. 5,10,000 is the cost of goods sold. Then gross profit, sales minus cost of goods sold is equal to gross profit, that is 3,40,000. 8,50,000 minus 5,10,000, 3,40,000. Then less operating expenses. Under that operating expenses, selling and distribution expenses 30,000, administration expenses 1,50,000, Then total of these operating expenses. In this problem, only two operating expenses, selling and distribution, operative expenses, operation. I will explain that in detail next classes. Selling and distribution, that is an operation cost, 30,000. Administration of the organization, HR department salary and other salaries, that is administration, 1,50,000. Total is 1,50,000 plus 80,000, that is 1,80,000. Operating expenses also we needed. Operating expenses is equal to 1,80,000. Here, gross profit minus operating expenses, 3,40,000 minus 1,80,000. That year 1,60,000 we call it as an operating profit. Operating profit is 1,60,000. That is gross profit minus operating expenses is equal to operating profit, 1,60,000 less interest, that is loan, interest payment on loan or advances, loans or advances. That is in this problem they provided that is 15,000. Then operating profit minus less interest is equal to 1,45,000. This is we call it as an PAT, profit after tax. Profit after tax, or sorry, profit after interest, PAI, profit after interest. Then after that, less non-operating expenses. Operating expense we already deducted. Non-operating expense is also provided in this problem. Less non-operating expenses, 4,000. That is 1 lakh. Profit after interest is 1,45,000 minus non-operating incomes, 4,000. That is 1,45,000 minus 4,000, 1,41,000. Then add non-operating incomes. If the non-operating income is there, that is also we need to add that non-operating incomes. Non-operating incomes that is provided in the problem, that is rupees 9,000, 1,41,000, that is plus 9,000, 1,50,000. Net profit is 1,50,000. This is the way of calculation. This income statement and position statements are most important for to calculate the different ratios. Without that, it is very difficult to solve the problem. It is time consuming. Therefore, if the income statement and position statement and ratios, how many ratios we need to calculate that in this provided in that problem, we need to give before go for that is ratio, income statement, we need to prepare that and move on to, I hope you understand this concept. Yes, we move on to position statement. That is not in that position slightly we say that is in capital employed. Capital employed is equal to, capital employed means debt plus equity is equal to capital employed. Capital means in the form of cash and machineries or in any form for that matter. Capital in the form of any ways or any forms, that is we call it as a capital employed. In general, capital employed is equal to debt plus equity. And what do you mean by equity? Yes, here equity, that is equity shares 2 lakhs. See the balance sheet, reserves. Why we create reserves? To face the unforeseen situation. Therefore, we create the creative reserves is also created out of profit. It is a reserves is a portion of the profit we create to face the unforeseen situation. Reserves we need to add that equity, that is belongs to equity shareholders. Shareholders. It may be equity shareholders or it may be preference shareholder. That is also belongs to that. Therefore, we need to add that reserves and profit and loss. If it is profit, add to that. If it is loss, deduct from that. Equity shares plus reserves less. If it is loss, less. If it is profit, add that. Plus or minus. Then outer column is 60,000. Total 2 lakh equity shares, reserve 20,000, and profit and loss account of the previous year 60,000. That is debt 2 lakh. Total is 2,80,000. Then debt is 70,000. Outer column. Debentures is 70,000. Total here equity plus debt. Equity plus debt That is, total is capital employed is 2,80,000 equity, then 70,000 debt, 3,50,000 we covered as an debt plus equity, capital employed. Then investment of capital employed, fixed assets, land and building, plant and machinery, fixed assets total, because only two fixed assets we have seen in this particular problem. Therefore, land and building 1,50,000, plant and machinery 80,000, total 2,30,000. Then investment of capital employed is 2,30,000. Yes, this is the information regarding this while solve the problems of to calculate the ratio analysis. Here usually they provided that is income statement, position statement, and how many ratios we need to calculate that. With the help of that we need to prepare a income statement and different concepts of income statement and position statement. With the help of that we can easily solve the problems, because cost of goods sold while means cost of goods sold is equal to opening stock, opening stock plus purchases plus direct expenses minus closing stock is equal to cost of goods sold. That is most important. Then average stock, cost of goods sold is equal to average stock is equal to opening stock plus purchase, opening stock plus closing stock divided by 2 is equal to, that is average stock. That is also, while solving the problem I will explain that. Tomorrow morning I took the class 10 to 11 for Sunday link. Yesterday's link, tomorrow 10 to 11 I will engage the class. Then as usual 12 to 1, that is Tuesday class. Okay, thank you. Tomorrow I will solve the problem. Then I will go to after that ratio analysis. We will move on to fund flow statement explanation, and if it's possible, I will solve the problem. Then cash flow statement. I will move. That is also I will explain the different concepts of cash flow statement. If it's possible, I will solve the problems. Then next we will after that we will move on to marginal costing. Their budgeting is there, marginal costing we will discuss about that. It's also these chapters are most important from the point of view of examination. Therefore everyone should before attending the classes, they should go through that study material. There will because pro forma, in case of fund flow statement, pro formas are most important. There are three important pro forma that is available. That is schedule of changes in working capital in fund flow statement, then sources and applications, that is appropriation account and sources and applications are most important. You should open an account in fund flow statement. Then cash flow statement is also, that is cash from operations. Then different techniques are there, application and sources of cash. That is also, these are all the techniques, pro forma that is available, all the pro forma that is available in our study material. You go through that, then only it is easy to, if I am explain that, you can easily understand that. Otherwise it is very difficult to, that is, understand this. Accounting is nothing but pro formas. Many problems, many problem related subject, the pro formas are most important. Therefore you need to practice that pro formas, and that is then only you can understand the problem easily and effectively. Okay, thank you very much. Tomorrow I will engage the classes on 10, that is AM, 10 AM. Then after that 12 PM as usual. Thank you very much. Thank you very much. Thank you very much, one and all. Tomorrow as usual. Yeah, thank you.